All right. All right. It's been a minute. Let's check on this real quick. It's been like, what, 3 months now since I've last uploaded? But, my channel, videos, newest. All right, it's been 1 month. All right, I gotta calm down. It's been a month now since I've last uploaded. But this video is gonna be long as shit because I'm gonna be going into detail about everything I think I've taught so far. There's a whole bunch of shit here on my second monitor. I am ready for this. I got the vape. I got the Coca-Cola glass with some water. I got the fucking, the cigars, you know, for the sake of this video. Take one out and put it on, what, this here, I think, since I'll be looking over here most. Can I? All right, I look like a fucking idiot. All right, that'll have to do. But, for all you who know ICT a lot, this video will help you too. But like from the start to the end, this will be progressively harder to understand. Like from the start, where I'm just gonna explaining each and everything, like the candles, the wicks, the bodies, pretty much everything like that. But like in the end, I'll be talking about new day opening gaps, new week opening gaps, 90-minute cycles. You know, it's gonna be fucking rough. I gotta be in bed in like 2 hours. All right, I say we just do this, bro. It's been 1 minute and 30 seconds. Yeah, let's just start from scratch. Reading the candles. Bullish candle. Your charts might look like, I don't even know what your charts look like. I think it's bodies. So bullish is what, green and red, right? Borders, red, green, and green, red. Like something like this, right? We'll just use that for now, I think, so you'll understand it much easier. I think, like, I do recommend you guys change this as soon as you open up the charts. Just change this to white and black so you become neutral. So you won't like change your like emotions, because it is emotional to trade. But for the sake of this video and for it's easy to you guys for understand, we're gonna keep this green as the chart is going up and red as then the chart is going down. First on the chart is a bullish candle. That'll be this guy right here. That is a bullish candle. It opens down here. I'm gonna change this to black. It opens down here and it closes over here. And let's just do bearish candle too. That one opens up here. It's good to remember where it opens and where it closes. And it closes down here, right? It opens up here, closes down here, that's why it's red. It opens up here and closes up here, that's why it's green. Next up we have wicks. Let's use this one because this one has wicks. This is a bearish candle. Remember, it opens up here and closes down here. But when it opened, it did actually push up. So when it opened up, the candle went like this, and then it went down here. I'm lining it up like right here. You see this line over here? Then it went like this, and then it went back up to here. And here's where it closes. So from this range to this range, this is the body, and these would be the wicks, right? So this means it opened up here, and then it went up here, but it decided to go back down. It went all the way down here and went straight back up, right? That's what wicks are. Same with green candles. Let me find like a perfect, this one. Remember, green, it opened down here, closed up here. But when it first opened, it came all the way down here, to right there. It went back up, went up to here, but came back down and closed right there. This is what all happened within a minute. So within a minute, it went down here and went back up here, right? I'm gonna move this to like right here. So my face is like in the dead center of it, right? Yeah. Face like right here. Cool. But bodies, again, I pretty much explained that, so I'm not gonna go into that right now. Swing highs and swing lows. I am gonna try to timestamp all this, so this will be a lot easier for you guys to just click over this entire section. But a swing high, I say we just go on the 1 hour chart to figure that one out, because it's easier to identify those. But a swing high is when a candle makes this thing, right? Actually, let me use like I'll use like a highlighter. So it makes this candle, right? Then it makes this, Jesus Christ, this candle, and then it makes this candle. You see how this wick is a lot higher than these two, right? So that would make this one a swing high, right? That's like a U. There's a candle right here. There's a candle right. Wow, this is wacky. But it's something like this, right? It's low, low, and this is higher. That would be a swing high. A swing low would be the straight opposite. Let me see. Where's the swing low? Right here. So we have this candle right here. This candle right here. We have this one is higher above than this one, and this one is also higher above than this one, which also creates like a perfect U, which is something like this, right? So this is higher, this is higher, this is lower, so that would be a swing low, right? Swing high, swing low. Liquidity, damn, we're straight into ICTs. A liquidity is where, let's say there's someone going long, right? We'll just start with sell side liquidity, right? Someone went long right here, bada bing, bada boom, right? Their stop loss would be at this low, right? Because there's no low beside it, right? So this buyer would be like massively in profit. I don't think we have attacked this low yet. No, we haven't. So this would be like major liquidity as of right now because the market is all the way up here, right? But this would be a major sell side liquidity. But this is where someone would place their stop loss, right? So this would be someone's stop loss. They will place it right here. They would enter somewhere over there. So if the market does like, it does something like this, right? It does like this and then it comes back down. They would get stopped out. That is what liquidity is. It's basically what I think about liquidity is it is a place where a buyer might put their stop loss. For buy side liquidity, it would be a place where someone would put their stop loss when they're in puts or selling the market, going short. They will probably enter right here, but go somewhere like this and put their stop right here, right? But the market did this right here, went like this, finally got stopped out. And you see, as soon as it touched it, went straight back down. But it did actually touch it once again. But this is not like somewhere a place where someone might put it. But this is definitely a liquidity, where a liquidity is put, right? This is liquidity, this is liquidity. We're on such a high time frame right now that pretty much any of these are liquidities. But if we go on like the 4-hour chart, a lot of these swings get disappeared, right? So this right here, this would be main drawn liquidity. And maybe this low right here too. If you're in a short, you would probably aim for this low. Or yeah, we are on the 4-hour chart, my fault. So this could also be liquidity. When we're on such a higher time frame, any of these can be liquidities for an intraday trader, right? But on a short term, if let's say this would be the 1 minute, this is the 4-hour, right? But hypothetically, this would be the 1 minute. These two here, this one and this one, we wouldn't really count this as liquidity. I mean, yeah, technically this could be all be liquidity, but we would be mainly focusing on this one because this is like a lot further down. Like the swings on this, the swing low, like as we just explained, is like, it's like this, right? It's such a big U, right? It's so big. So as of right here, this is such a big U. So on the 1 minute, this would have to do it for liquidity. But for 4-hour, this can also be it. This can also be it. This can also be it, right? I think that should be enough for liquidity. But yeah, sell side liquidity is this right here. Sell side and buy side liquidity would be something like this up here. But what I think about when I think liquidity is when someone, or a trader I should say, is where they are going to put their stop loss. So if the market does go in that direction, they're going to get stopped out. Let's talk relative equal swings, and then we'll talk about equals. But we find like a good I think these are relative equals, yeah. So these are relative equal lows. On such a higher time frames, this would be an immediate draw. Like I would definitely try to target this because the market doesn't really like equals or relative equals. It's like so many liquidity pools. Like this entire thing here is just one big liquidity pool that they want to get taken out. Like this is not what we want to see. But on lower time frames, like if the market opened somewhere over here and it did all of this, like we wouldn't really focus on these, because if we just go on the on the 10-minute, these swing points will all become one, you know? Like the higher you go, the fewer swing points there will be. Someone called Tactical Traders calls this internal liquidity. It's because the higher you go, the swing points will pretty much just disappear. They won't exist. But on such a higher time frame, like the 4-hour chart, this would be like where I want the market to just pretty much try to take out straight away. Like it did try to go for it here, but we're on a higher time frame. So this sell side liquidity over here is what is enough to get the market to reverse back up, right? Hold on, misplaced it like so. If you see, yeah, since I've already talked about wicks and bodies, wicks do the damage, but bodies do the talking, right? So the wicks went below this line, right? This sell side liquidity on the 4-hour chart. They went below right here, but the bodies, they went straight back up. Remember, the candles went down here, but immediately rejected off of it. So the wicks do the damage, the bodies do the talking, right? All right, so these are relative equals. This is on higher time frames. Again, this is where the market would like to target. On lower time frames or internal liquidity, this is something that we won't really care about, because if we just go on the 10-minute or the 15-minute chart, these swing points would all equal to 1. Now let's try to find equals. We're on such a higher time frame, so it's gonna be hard to find equals. Let me just go on the, not the 5-month, calm down. On the 5-minute chart, the market just opened again. Let me see if we have any equals. These are relative equals. Relative equals up here, like this would obviously be some sort of draw, right? Relatives, I guess you go like on ESU 2023. Let me remove all my drawings. Equals. These are relative. These immediately got tapped out. But like, yeah, I think this, right? This is equal. Yeah, this is equal. So these highs right here, as soon as the market dumped down right here, I would immediately look at these. This is on the 5-minute chart, so I would get a little worried about these highs, but not really. Like I want to see this. If I see this on like the daily chart, this would be immediate draw. Like I would definitely mark this out like straight away. But on the 5-minute chart, I would be worried about these. I would keep an eye on these. But as soon as I see like the market displace up here, I will explain that in a bit. I would immediately think like if I were in a trade like over here somewhere for some reason, I would just get out of the trade right there, you know? Like I would just kill the trade on after we take these equals, because that's enough for me. What do we have next? We talked about relative equal swings. We talked about equal swings. I'm gonna explain stop rates right now, which take into apart buy side and sell side liquidity. We can use this high, right? This high is such a big U, remember? This liquidity pool, this is such a big U that this is an immediate buy side liquidity that I will look for. So let's mark this out as buy side liquidity. Where the fuck is that? Right here. A stop rate is where the chart continues to go up. Like you see the bodies, remember the wicks do the damage, bodies do the talking. The body closed above this on the 5-minute chart. It closed above this. So I would get worried of this accumulation right here. But this is what ICT calls a stop rate. This is when the market just completely obliterates every single seller, right? Somebody sold somewhere over here, put their stop up here, and it just kept out taking out sellers. Somebody sold right here, it took them out. Somebody sold right here, it took them out. Somebody sold right here, took them out. Sold right here, took them out. Sold right here, took them out, right? That's what a stop rate is. It's just, it keeps taking people out who keeps trying to short. But we displace right here. This is what a displacement is. I guess I'll just talk about that right now, but that's a little further into my discussion. But this is what a displacement is, right? The market does something like this, does something like this, something like this, something like this, and then it just boom, right? That is what a displacement is. It's just, it goes into the opposing direction with good amounts of strength. This is actually non-form payroll. So this is actually a huge displacement. This is like 100 or so ticks. Yeah, pretty much 100 ticks. But it pumped up, created a stop rate, and then just dumped down, right? This is what a displacement is, but this is what a stop rate is. It takes out buy side, or it could also be sell side, right? If we just flip this over. And it just stays a little bit above this. It never goes actually higher and continues higher with the same amount of strength. And it just does this, just back and forth, back and forth, back and forth, and then displaces straight back down. This is what a stop rate is, right? I think I'm talking a little bit fast. I hope that's okay, but I'm a fast talker. What do we have next? We have a change of character, break of structure, and a market structure shift. I think I'll talk about market structure shift when I talk about intermediate and short-term highs and lows. Let me move that over right now. Market structure shift. I'll move that over to when we talk about the swing points, when they are necessary, or when you read off swing points. Bro, I'm watching my face cam right now. I look like a fucking idiot. Change of character. I'm gonna go on the 1 minute chart for the change of character, because that's where most people get stopped out with using change of character. But let's use here, since I just talked about people getting stopped out of change of character, I'll use that right now, right? We have this swing point, right? Even though this is the same level as this high, we would still consider that a swing high. As soon as, if it goes above that swing point, it's no longer a swing high. But let's use this swing high right here. We could also just use this middle one over here, since it is all the same levels. But let's say this is a change of character. That's when the market breaks over this swing point. Like the body closes above it. This, like, it displaces above it. Let's say that. It displaces above that swing point, right? We would have a change of character. It does it once again over here. That would be what we call a break of structure. That's a BOS, break of structure. This would be a change of character. Maybe many people will try to enter right here. I will explain that in a little bit, but some of you might already know what this is. Some people might enter off this retracement right here and then aim for, let's say, this high over here. But this is on the 1 minute chart, so a change of character and a break of structure on the 1 minute chart is no good. I do not recommend going off the 1 minute chart if you're looking for a break of structure or a trend reversal. Because as you can see, like we've been bearish, right? We've been bearish, you know. So why the fuck would you go long on a 1 minute break of structure, or a change of character, I should say? Change of character displaces, retraces. You would enter, aim for this high up here, but your stop loss over here. But unlucky, you get stopped out, right? But a change of character is when the market is looking like it's going to reverse. A break of structure is somewhat a confirmation that it's going to reverse. But I wouldn't necessarily trust this break of structure. I would rather try to wait for this to get displaced over. But it never actually did displace over. It kind of just like popped its head up, right? You could consider this a stop rate. I mean, you definitely could consider this a stop rate. But that is what a break of structure is, or a change of character. It's a high that gets displaced over. A break of structure is when that happens again, you know, twice in a row. Change of character and then a break of structure. Change of character right here and then a break of structure, right? That's what it is. I think that's enough for a change of character and a break of structure. All right, fair value gaps. I'll just use the same exact example, right? why someone would enter this long but not be profitable. A fair value gap is when you look at 3 consecutive candles, 3 candles in a row. We have this candle, we have this candle, and we have this candle. It doesn't necessarily matter what direction they are all going, if they're bullish or bears, but we can see that these 3 consecutive candles leave this gap behind. This gap is what we call a fair value gap. ICT says that this gap right here is when the market doesn't offer a fair value to buyers or sellers. It's when the market pretty much displaces so great that it never actually gets filled in time. So in these 3 minutes and during this price leg on ES, this 3-tick price leg, nobody got the price that they wanted to enter off of. But the reason why I said somebody entered off this is because we enter off fair value gaps. Us smart money concepts traders, we enter off fair value gaps. So if somebody would use this change of character plus this fair value gap, it will not work because it's the change of character's fault. It's not the fair value gap. Trust. I'll show you on the 5-minute a fair value gap entry that would actually work. I'm gonna go back to NQ because that's what I trade and that's what I feel most comfortable on. But on the 5-minute chart, that's where I want to see shit get broken over. I'll use change of character for this. I'll not use market structure shift. I'll use change of character for now. This would be the change of character, right? This swing point right here. This is the displacement that I'm looking at. It displaces, and we finally have this fair value gap right here and this fair value gap right here. Remember, 3 consecutive candles leaving behind the gap. So that would be these 3 leaving behind this gap and these 3 leaving behind this gap. Off the bat, I would immediately enter off this one right here. Like as soon as it touches the gap, I would be in. I would put my stop loss below the fair value gap, or maybe like at this candle over here, like below this candle, and I would be aiming for let's say this high right here. That would be my target. I immediately go into profit about 60 ticks, 66 ticks, and I go straight back into drawdown. We consolidate inside of this fair value gap. This consolidation right here is probably what I would enter more. Like 1 mini right here, another mini somewhere over here, and 3rd mini over here. And then I would just write this out. And somewhere further into the line or into the trade, I would find my TP would finally get hit. But that's why I trade on the 5-minute chart. It's so much better. The 1-minute chart, it sucks. It sucks. I don't like it. I keep losing on the 1-minute chart. But this is what a fair value gap is. Yeah, we'll talk about the specific fair value gaps, right? This right here is what we call a sell-side imbalance, buy-side inefficiency, or a SIBI. Here, I'll draw this out. I'll make this red so you understand it. And then I'll type in SIBI. That is a sell-side imbalance, buy-side inefficiency. What that means, it's a bearish fair value gap, which means if the market does tap it, which it never actually does, it actually taps this one over here. So let's just use this example, right? We'll just use this one. When the market actually taps it, it goes straight back down, right? That's what it means. A SIBI just means when we tap, we go down. For a BISI, which is a buy-side imbalance, sell-side inefficiency, we'll use, I'm trying to find like examples. This one, right? Turn this green and I'll type BISI. When we do actually tap it, right, we go straight back up. That's what we do. Bada bing, bada boom. Stop loss right here. So when we do tap it, it just, right, hey, it's a green candle, and when we tap it, we go green, right? That's what a BISI is. Next up, we have balanced price range. A balanced price range. All right, let me find that real quick. That's going to be rough to find on a 5-minute chart. I think we have one on the 1 hour. All right, right here. We never actually get tapped into this. All right, whatever. We'll just have to imagine it, right? A BPR is a BISI and a SIBI getting like obliterated at the same time. So we create this bullish fair value gap, we go above it, and then we completely destroy it. That means we have a BPR. I usually make them cyan, and they're called BPRs. So hypothetically, if the market touches it, we'll go straight back down, right? So if it's a green candle first and then a red candle, that means if we tap it, we go down. And if it's vice versa, if we tap it, we go up. Pretty much what it was before. So if this is a SIBI, right? This is a SIBI. So if we do tap into it, I'm gonna just actually keep it at the BPR level. If we do tap into it, we would go down. But this is actually a BPR, which it's pretty much a higher probability fair value gap. Like if we do actually tap it, there's a much higher chance that it will go down rather than just a regular SIBI. And yeah, that's pretty much what a BPR is. We tap it, we go down. My fucking throat is killing me. And I got a fucking cigar in my ear. All right, cool. All right, displacement. I have covered that, but I'll just quickly go over that once again. I'll take a change of character with it too. We'll just use this one right here, right? This is a swing point, a swing high. Bam, we tap into it. Right here, we break above it. Change of character. We displace, remember, that's when we are bearish and then we switch direction and go completely bullish. Actually, we're still bearish on this one. We tap this SIBI over here. All right. Should I use this example? Sure, I'll use this example. We displace in the opposite direction. We go down. We never take this sell side over here, which immediately I will be ticked off into thinking we're still going to go further down. But we go down, we create a higher high, we create a higher low, and then we displace. We go straight back up, right? We have a change of character. We have this fair value gap. I'll try to use all the terms that I have explained again, so you'll just get a better understanding of them. We have this BISI, bullish fair value gap. You would enter right here, stop right here below this candle, and you'd be aim in this case for this. But if I were actually be trading this, I would actually be aiming for this, and I would kill like half of my cons at this SIBI and then put my stop at break even once we tap this SIBI. But yeah, that's what I would do if I were trading this. This was at PM session, so I wouldn't have taken this. But yeah, change of character, it displaces, right? Displacement. It with great velocity, it reverses. And then it gives an entry. Bro, my fucking throat. Order blocks. Oh, I like them. I like them. Some order blocks. Let's go back to the beginning of where we are today. We'll use non-farm payroll, I guess. Or we're on the 1 hour chart. Let's go back to the 5 minute. Here, non-farm payroll. Let's use that. So, order blocks. Order block is, I'm trying to find like a good example of it. We'll use Tuesday, I guess, right here. Right, we have, does this order block get violated? It barely does. Here, let's just use this one, right? So for a bullish order block that says us to go up, you would need a bearish candle. Personally, I would only enter when it touches the body itself, right? The body itself plus OB, right? That's when I would enter. So like I would enter over here, I would enter over here. However, an order block is this entire range right here. So for some reason, if the market goes like down here and then back up, that's still valid. However, I would still just try to enter as soon as it touches the body. You could also just enter immediately when it touches the wick. That is also still valid. That's also a bullish order block. For a bearish order block, when we reverse our position, we would need a bullish candle. So let's just use this one, right? This would be a bearish order block. You need a bullish candle, a bearish order block, right? So once the market goes below this and tries to tap it again, and taps it again, and taps it again, that means we're going to continue down. In this case, it just goes back into a fair value gap, but that's not really important right now. Again, it can be this entire range right here, this entire thing. It's completely fine if the market, like, see, it goes all the way up to the order block, but somehow it still reverses. Actually, it destroys the order block. This order block might not be valid after this. But personally, I would enter off the green candle itself as soon as it touches the body, like right here. I would enter this, stop loss over here, targeting this low. But some people would enter as soon as it touches the wick of the order block. Some people would enter like at the 50% mark, but it's up to the person itself. But I usually just go off the body itself. But you count the wicks too. The wicks also count for an order block. Breaker blocks. Oh, this is gonna be a difficult one. This would be a mitigation block over here, so I'm gonna just mark that out. I mean, yeah, nah, this technically doesn't work. I have to find a bearish and a bullish breaker. You kidding me? I'm gonna try to do this all like in a single recording, so it's just easier for me, and like this will all be valid for you guys. All right, this one actually works. This one over here. This is not a good example, but just get used to it, right? So a breaker block is when the market, I'll just do an example of it first. The market does this, it goes back down, it takes the high once again, and then it goes back down, right? The order block it leaves behind right here at the bottom, right? That would be a bearish breaker. So when the market taps it, you can place your trade right there, stop loss over here, and targeting like the low again. So if the market does tap into it, it's just gonna go down, right? So this is something like a breaker block would do. Goes up, goes down, takes the high again, and then displaces back down. That happens right here. It goes up, it goes down, it goes up, takes the high again, and displaces. It leaves behind a bearish order block right here. Or for a bearish breaker, it needs to be a bearish candle. So if it's gonna go down, you have to mark out the bearish one. So that's this one right here. This would be the bearish breaker block. I am hoping you guys are also finding examples in your charts and not just watching me. But you would enter right there. You would put your stop above the breaker or somewhere like over here. I would put my stop like above these swing points right here. And then I'd be aiming for this low and then holding runners left until I get, I don't know, stopped out or maybe kill the trade like at, let's move it like over here so you can see, and then kill it at these swing points right here. But I would take most of my cons right there at 176 ticks on NQ. I'm pretty happy with that. That's what a bearish breaker block is, right? A bullish one, wow, we have one right here. A bullish one is when the market does something like this. It comes down, it goes up, it comes further down and goes back up. So once it taps that line again, it continues. Right here, right there. Bam, stop loss somewhere over here. And then targeting the last high, right? That's what a bullish one is. We have that right here. It comes down, it goes up, fails to take the high, goes down, and it goes back up, comes back down, goes back up. For a bullish breaker, it would be a bullish candle. Bada beam, touches it by a tick or so. Have your stop below the breaker or somewhere, maybe these swing points right here. Right, these swing points. Let me move this yellow line. And you'd be aiming for the last high. However, this, what the fuck is this? What happened on this day? I don't know, but this would be a bullish breaker, right? Goes down, goes back up, fails to take the high, goes down, takes the low, this low right here, goes back up, and then retraces into the breaker. All right, Jesus Christ. All right, this cigar has to go. Mitigation block. That's the ugly sister of a breaker block. I don't like to trade mitigation blocks because they're simply not good. Let me see. Mitigation. These are all just breaker blocks. Mitigation. This one, yeah. All right. Hypothetically, can we use this? Oh, actually, we can. All right. Example. For a bearish mitigation block, it'll make a high, it'll make a low, it'll fail to take the high, go back down, like this, right? So, it creates a high, creates another, or a lower high, creates an order block, and this is your entry. That happens right here, right? Creates a high, right? Creates a high, creates another high. It has a bearish order block right here. Remember, bearish equals down. So it's vice versa for a regular order block. You could use it right here, but this is after market open. So like nobody would actually trade this. But you could enter like entry right here, entry right here somewhere in this, entry right here, entry right here. You'd aim for like the closest low or the last low. So yeah, like this maybe, or this, or this. Maybe this. You try to aim for this. It actually, you gotta, oh never mind, you get stopped out before. But yeah, this is what a mitigation block, right? Goes up, or a bearish mitigation block, sorry. Goes up, goes down, goes up again, fails to take the high it just created. Displaces, it actually has a change of character, and taps it once again. Alright, bullish mitigation block. Maybe somewhere over here. I mean, you could count this one, right? This is such a small one, but I am going to use it to show you that these small ones do actually count, right? Right here. Right. So, let me see. Actually, this is a breaker cock. What am I on? Maybe somewhere over here. I can't find a real life example of this, but a bearish mitigation block is it comes down, goes up, goes down again, goes up, gives entry. It creates a low, it creates a higher low, and then it has a bullish candle, right? Which gives entry. I don't trade mitigation blocks, I never do, but this is what that would look like, right? But you have to remember, for a bullish order block, it needs to be a bearish candle. But for a bearish breaker and a bearish mitigation block, it needs to be a bearish candle, right? Order blocks is the vice versa of what the market is going to do. But for a breaker and mitigation block, it's going to be the exact same candle that the market is going to do, right? What do we have next? Propulsion blocks. That's actually pretty easy to find. They're everywhere. So it's pretty easy to find propulsion blocks in these sort of consolidation models, right? So I'm not actually going to use that. Try to use like something that actually does get tapped into. Maybe it's a good, yeah. So these three candles right here, they all consist of a single order block. right? So this is a bearish order block. Remember, bullish candle, bearish order block. This is a bullish candle, and these three are bullish candles, right? They do tap into each other just barely, but that does count, right? This does count. So this one right here, this would be a bearish propulsion block. Once it breaks lower, so once the market goes below this order block, so let's use this candle for example right here. So we have this order block right here. We have this order block right here, these three, right? They tap into this one and the market continues down. So this order block is a higher probability than this one because it tapped into this one and respected it. So once the market taps into it, you could enter short, but we are bullish, right? Yeah, we are bullish. The market is continuing upwards. So I don't think you guys would enter off of this, but this is just an example of what a propulsion block is. So this would be right here. This would be your stop. You'd be aiming for, pretty much you'd be aiming for these lows. This is actually a pretty bad trade, but this would actually give you a win. Fucking 80 ticks. I mean, that should be enough for somebody, right? This one actually does give you a win, but yeah. Order block gets tapped into and respected. It goes below this order block, taps it once, taps it twice, goes down, taps it 3 times, and then continues downwards before actually going fucking rogue up here. Now let's find a bullish one, hopefully in these charts again. I mean, yeah, these two, right? They don't get tapped into. Or the market pumps over here. No. No. Alright, this one. So remember, bullish order blocks are bearish candles. Am I still recording? I am. Bullish order blocks are bearish candles. So we have this order block, we have this order block, this order block right here. So you could just immediately enter off right here, but I would enter off the body itself. Let me draw this out for you so you understand it. Jesus Christ, this is a big stop. This line would be a plus PB, propulsion block, right? So it taps into this one right here, see? Taps into this one, respects it, goes above it, and taps it again. So this would be a propulsion block entry. My fucking voice is leaving me. Alright, I think that's enough. Hopefully you guys understand that. Alright, now we do fib retracement tools, or the fib tool. This guy right here. This guy right here. Love this guy. I use this guy so often. I use this one like 3 times per trade. So listen up. Let me see. Alright, let's say you were going to enter this right here. This right here. You were going to enter this bullish, this uprise here. Of course, you wouldn't know that live, but let's say you wanted to enter that. So, for a fib tool to be used, you want to take the displacement leg itself. That means the first bullish candle of the bullish displacement up to here, right? Before it starts to retrace. Actually, it'll be up to here. So your entry would be below the 50% mark. That means your bullish entry, or your long, would be in a discount, meaning you'd get such a good price. So if you would enter off this fair value gap, right, for some stupid reason, I personally would have entered off this. I would just enter somewhere in this range, like maybe this fair value gap over here. I would enter over here. But for some stupid reason that you would enter this close to the discount range, you would place your stop right there, over here, with 54 ticks, right, of risk, and you'd be aiming for the high it created, right? So that would be all the way up here. This trade is 4.3 RR. If you enter that that deep into discount, right? Not many ICT traders actually do this. I mean, mega gods and menaces would do that. But personally, I would enter somewhere below the 0.62, right? So this is my fib setting for the optimal trade entry. That is 0.62 to 0.79, right? That is the optimal trade entry, which ICT talks about. So somewhere in this leg right here, I'm gonna just draw it to the fib itself, not to the fair value gaps that are over here. So I would pretty much just enter like the first fair value gap below that, which is over here. So that would be my entry. My stop would be below the displacement leg, and I'd be aiming for the same high. So my personal trade would have been pretty much 3 RR, but if some idiot was this good, his trade would be pretty much 5 RR, right? So above the 50% line, that's premium. That's where idiots would place, like, enter at this fair value gap, you stop down here, aiming for up here. This would be a 1-to-1 RR, right? For us, smart money concepts, we would enter it down here, 3 RR to 5 RR. So yeah, above the discounted line, I'll just use the GAN box for this, right here. So above this range, above this percentage right here, this is premium. Below it is discount. We want, for longs, we want to trade in the 50% below, and for shorts, we want to trade in this range, right? So if you want to short here for some stupid reason, this is where you want to do it. If you want to long here for a very good reason, you do it over here. That is premium and discount arrays and optimal trade entry. Now for a TGIF, which is on Fridays. So let's find Friday. So Friday, I don't know if TGIF was today. So this is daily, this is Friday. We draw it from top down here, do TGIF. So here, I'll show TGIF settings real quick before I jump into the 5-minute chart. So the first one is 0, second one is 0.2, third one is 0.3, and the last one you could also just do it over here and do 1, right? So 0, 0.2, 0.3, and 1. You go back to that, go back to the 5-minute chart over here. Why is it like this? Something like this, right? Fuck it, I have to draw it out all the way to over here. Bam, like this. So, oh shit, it was a bullish day. Damn, we were bullish on that, or bearish on that day. So we would draw it on the other side. We would draw it from down here to up here. Right? Down here to up here. So we would try to enter short up here. And we would be aiming for at least to the 30% mark. But if you were a menace and hold all the way down to here, fucking good job. But TGIF, I'm not going to explain that in this video. It's just on Fridays, the market wants to retrace to 20 to 30% of its entire weekly range. I went on the daily chart. Fuck, I'm stupid. But yeah, that's what you do with the weekly chart also. But on weeklies, it trades to the 20% line, 20 to 30%. But I'm not going to explain that in this video. But that's what TGI fib tool is. Main threshold. Main threshold is when the market taps just the 50% line. I use the GAN tool for this. But yeah, see, it taps the 50% of the fair value gap. And that could be your entry too. Aiming for this low right here. Yeah, that's what main threshold is. Main threshold is the equilibrium, which means 50% in trading terms. Equilibrium of the fair value gap, of the order block, of the wick, of the body of something on a higher time frame. You can mark out the 50% of the wicks and bodies. But once the market closes or displaces above the 50% line, it destroyed the main threshold of said fair value gap, order block, breaker, whatever. right? So if you want to enter off main threshold, or if somebody's entering off main threshold, they are entering off the 50% mark. Holy shit. We're 50 minutes into this video, and we're, I think, at the halfway mark. But we're gonna talk about time soon. We have volume imbalances and liquidity voids left, and then we talk about time. That's gonna take a long ass time. No pun intended. For the volume imbalance and for the liquidity void, I am gonna go on the daily chart because we have a liquidity void and a volume imbalance there somewhere. Let's just go like further way back because we usually have liquidity voids back here. All right. For demonstrations, I am going back to February the 16th, 2023 for the liquidity void. But this is what a liquidity void is. It is a gap in the market that needs to be filled, right? On higher time frames, you should be scared of voids. You should be keeping an eye on liquidity voids. But on like the 5 minute and the 1 minute, liquidity voids aren't, again, that scary. You should take into consideration equal highs, relative equal highs, and liquidity voids, and VIBs the same. But voids and VIBs, volume imbalances, are valid entries to enter off of. So like somebody could definitely short this right here. Like that is a valid entry. But that is a liquidity void, right? You see there's nothing here. That is a liquidity void. And a VIB is this right here. Is when wicks overlap each other's but no bodies. These are you see these pretty often on the 1 minute chart. If you like zoom in, you see the VIBs pretty much every time. But on the 5 minute chart, if you see a VIB, definitely look into to try to get an entry off of that. But yeah, liquidity voids, VIB over here. We have a VIB over here. We have a VIB over here, here. Another one here, and this massive one over here. Here's a VIB, right? They're pretty much everywhere. If you look hard enough, you see them. Right. Holy shit. I feel like I'm talking too fast. Yep, we're 52 minutes in. All right, now we are officially into time. Judas Swings, which happened at 7:30 and 9:30 a.m. All right, a Judas swing is when the market goes into a single direction with great velocity or with great displacement. So for 7:30, this is actually non-firm payroll, so this 7:30 Judas won't make much sense. But as you can see, this is the 7:30 and 8:30 Judas swing combined. I don't really mark out the 8:30 Judas, but this is the 7:30 Judas. It just fucking obliterates it. And here is the 9:30 a.m. Judas swing. I will also look on another days because this pretty much doesn't make sense. But this would be the 9:30 Judas. The Judas swing will always take out some sort of liquidity, volume imbalance, fair value gaps, SIBIs, BISIs. Pretty much the draw on liquidity for that specific session would get taken out. In this case, it was this high. I think there was also another high on the 1 hour chart. But for the 9:30, it took out this Sellside liquidity, right? This was the Judas Swings goal, to taking out this liquidity. But that is what the Judas Swings are. Let's go to another day where the Judas Swings actually make sense. 7:30 is over here somewhere. 7:30 and 9:30 is over here. So the 9:30 Judas was taking, it seems like this high over here. This is what the 7:30 Judas took out. And then you could have entered short, right? You could have entered short, maybe. What the fuck? Or something happened on this day too, since 8:30 did this bullshit. But if there weren't news, you could have entered short, stop at this high. aiming for these lows, right? Probably killed it at 50% mark or main threshold of your price range. So from here to here, you probably would have killed like 50% of your trade, 50% of your lot over here, which is 135 ticks. That's not bad at all on NQ. 930 Judas, it was bullish. This Judas swing was for an hour straight, goddamn. But what did it take out? Let's figure that out real quick. So it took out, it seems like this high over here. Did it take it out though? It didn't take out the high. It tried to go for it, but it failed. But next day it did actually take out that high. But that's what the Judas swing is. It goes for a fair value gap, a liquidity pool, equal highs, equal lows, something. The Judas swing goes for something. You could trade the Judas swing itself, but I usually trade the retracement of the Judas swing. But yeah, that's what the Judas swing is. I feel like I'm not explaining this in detail enough, but that's pretty much, it's that simple. That's what the Judas swing is. That's all it does. Power of 3. So for the power of 3, you need to mark out the, I'm gonna do Tuesday. So for Tuesday, you need to find the midnight open. So this is a bullish candle. So you find the opening price of said bullish candle. Then we go back to the 5-minute chart. You mark this out. This is midnight open. So the power of 3 is consolidation. So this it would be the consolidation range, right? This entire fucking Judas swing. So it's consolidation, and then it goes below, right? The midnight open. Also, is this for value gap over here? So this is actually a perfect long. Goes below midnight open. You would enter below midnight open, right? You would enter below it. Stop loss at this low right here, this one. And you'd be aiming for this high, this high, this high. I mean, nobody's aiming for 400 ticks. Most people just kill it at 200 or this high right here. But that would be your trade, right? So power of 3 is, it accumulates up here. This isn't accumulation for some, but this would be the accumulation of the power of 3. But the power of 3 is accumulation, manipulation, distribution. So it accumulates above or below midnight open. Then it manipulates it to go above or below midnight open. So if it accumulates over here, it would go above, and then it would distribute to the downside. For this example, it accumulates above midnight open. It manipulates to bottom of midnight open. You would enter long below midnight open, and it would distribute to the upside. So that is what the power of 3 is. I think it happens once every day. I'm not sure though. I've stopped using power of 3. It worked for me the first time I discovered the power of 3, but I haven't used the power of 3 in like months now. I think 3 months. We're closing in on 3 months. But here are times to mark out. These are times that I mark out every single session, right? We have midnight open. I'll mark these out with you. I'm gonna do an anchor note actually. Anchor note. Oh shit, this is not an anchor note. Anchor text, right? Do this. We'll make it yellow. Make it bigger. All right. So let's just do for Friday. So we would mark out midnight open for Friday. Let's find out real quick. Midnight open right here. You would mark out midnight open. Then you would mark out 5 a.m. open, which is this. Then you would mark out 9:30 open, which is this. And then you would mark out 1:30 p.m. open. So that is after lunch, which is this. So for midnight open, you would use the power of 3. For 5 a.m. open, you would use that to figure out if the market is a high probable market. That means if the market keeps hitting 5 a.m. open, like 2 or 3 or 4 times a day, so like it taps it once here, taps it twice here, third time here, that means this day is a high probability day. Even though this is non-farm payroll, this would actually be a high probable day after it has hit it 2 or 3 times. So this consolidation range would probably be a high probability market. 130 open, you would use that as support or resistance. So if the market is below it, it would bounce off it and go back down. If the market is above it, it would bounce off it and go back up. That's why you use 130 open. For 930 open, it's the same as 130. If you're above it, it would bounce on it and back out. If you're below it, it'll bounce to it and back down. That's what these prices do. Just remove drawings. All right. How long are we into this video? 1 hour and 1 minute? Jesus Christ. I have to be up in 6 hours. What do we have next? Short term, intermediate term, long term, and market structure shift. We'll go on the 5 minute for that. Let's use this consolidation. So we'll just start with short term. We'll do that on the 1 minute because every single swing point is a short term on the 1 minute pretty much. A short term high is a high that is just a swing point, right? Any swing point you see is a short term as of right now. What I've taught you as of right now, every single swing point right here is a short term. So treat it like a short term. Every single swing low is a short term. So treat it like a short term. For an intermediate term, it has to be a swing point that rebalances an imbalance or has 2 short terms beside of it. That means this short term is an intermediate term. Why? Because it has this short term high over here and it has this one over here. So that would make this one an intermediate term high, meaning your stop is safe over here. Like it doesn't get tapped into it until, what the fuck? Is this market open? Jesus Christ. Yeah. It won't get tapped into until fucking Sunday. That is an intermediate of swing points. Intermediate term highs is a high that reestablishes a fair value gap. So remember, treat every single high as a short term until you figure out what it is. But as of right now, this is short term, right? But we have this fair value gap. It fills it out, meaning this would also become an intermediate term. But this would also make this an intermediate term. Just because this is no longer a short term doesn't invalidate this one, right? So your stop should also be safe here. It can, no, this, yeah, this is also an intermediate. But, I mean, swing lows are the same, right? Short term, this is also short term. So this swing point right here, even though it doesn't have wicks, this is an intermediate because it has this short-term low and it has this short-term low, making this an intermediate. So if you were long for some stupid reason, this would be a valid spot for your stop, but that means your bias is wrong because you shouldn't be long right there. But a long-term high is a high that has an intermediate term to the right of it and to the left of it. Same goes for swing lows. This is an intermediate term. This is also an intermediate term because of this swing point and this swing point and this swing point and this swing point. So this is an intermediate term right here. This is an intermediate term right here, which makes this one a long-term high. So if you place your stop over here, your stop is extremely safe. it's such a low probability that your stop will get hit. Such a low probability. Right. I don't know if I should explain it on swing lows, because it's the same exact concept, but with swing lows, right? To the left, to the right, or if it balances and imbalance, right? So this right here would be intermediate term low. This is a long term because this is an intermediate. This is an intermediate. This is a long term low because it has this low and this low to the left of it. Right, it's the same concept for swing highs and swing lows, for a short term, intermediate term, and long term. Again, you treat every single swing point as a short term until you figure it out if it has changed to an intermediate term or if it has changed into a long term. You don't assume swing points to be intermediate term just because it's swinged all the way down here. This market could definitely just swing back down here, right? You need to validate that swing low before you can place your stop there. Oof. All right, now that we have that covered, we can now go over market structure shifts. So there are differences between a change of character, a break of structure, and a market structure shift. A change of character, again, is just a swing point getting broken over. A break of structure is that thing happening again. However, this is a market structure shift. Why? Because this is a swing, a short-term swing high, balancing an imbalance and failing to go down, and the market goes back over it. So this short-term high becomes an intermediate term high. Once the market breaks set intermediate term high, it is a market structure shift. So this is the last example I used, I think, for, right? No, it's not. So this is a market structure shift. We know for a fact that the market is going to go up, right? We know for a fact that the market is going to go up. So if you enter off this fair value gap or this BISI, if you enter off this BISI right here, it's a good fucking long. Stop below this. You're aiming for this high right here, right? It's going to be a fucking long ass trade. Does it ever get tapped into? No, it doesn't. You probably just kill the trade like right here at this candle. But like 200 ticks, right? That's more than enough. But this is a market structure shift. It's when a swing point gets turned into an intermediate term and then the market displaces over it. That is an immediate market structure shift. So you know for a fact, if you're on the 5-minute chart, not on the 1-minute chart, if you're on the 5-minute chart, you know for a fact that the market is going to reverse. That your long is going to be a good long or a good short, right? So let's use this thing right here. This is an intermediate term low, right? It rebalances this imbalance. So this is a market structure shift. It leaves behind this fair value gap, creating an intermediate term high, which is also your entry. So as soon as it displaces all the way down here, 250 ticks, immediately, like off the bat, you can just move your stop to BE, right? No drawdown. Like even if you would enter here, right, you would put your, for some reason, like as soon as it touches this, you would enter as soon as it touches it. So you would enter on this candle right here. Your stop would be like at this high right here. But as soon as you are 150 ticks in profit, you can move your stop to this high. So immediately your trade went from what? Your trade went from a 1.4 RR. It displaced back down. It went straight to 3 RR. Right? That's what it is. Right? That's what a market structure shift is. It's like a solid confirmation on the 5-minute chart, on the fucking 5-minute chart, not the 1-minute chart. If you see a market structure shift on a 5-minute chart, you know for a fact that the market is going to go down. So that is short term, intermediate term, and long term swing points. And that is a market structure shift. Next up I have fractals. I'm not going to talk about that because I don't use that and I'm not going to explain that. 90-minute cycles. How long is the video? 1 hour and 10 minutes? All right, that's fine. 90-minute cycles. We use this tool over here. This tool is the Fib time zones. For the 90-minute cycles, you want to +1 everything. So 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, right? So you're going to go on the 30-minute chart. You're going to go on the 4:30 mark, right? So 4:30 right here, you see below here. 4:30, draw it out to 6 a.m. Bam. Now go back to the 5-minute chart. So 4:30 to 6 and 9:30 is over here. So let's just look at time. Forget about price, forget about fair value gaps, forget about market structure shift. Let's just look at time. So from 6 a.m. to 7:30 a.m. is accumulation. The market accumulates in an upwards direction. From 7:30 to 9 a.m., the market is in manipulation. And the market fucking manipulates, bro. It's shit pumps. Right? So it manipulates to the upside. From 9 a.m. to 10:30 a.m., the market is in distribution. Accumulation, manipulation, distribution. Right? So you could enter this short, right, with your fair value gap, with your market structure shift, and with your 90-minute cycles. I'm just going to explain the intraday 90-minute cycles. I have a video about the monthly, the weekly, and all the other markets. But for now, I'm just going to explain how I use 90-minute cycles on the market. But just from time, from 9 a.m. to 10:30 a.m., with your fair value gap, with your market structure shift, you can be confident that this short is going to play out perfectly. All right, so from 10:30 to 12, so again, accumulation, manipulation, distribution. From 10:30 to 12, you're going to have either continuation or a reversal. So a reversal back into the range. In this case, it was a continuation down. The market continued to go down with the distribution. So from 12 to 1:30, we have accumulation again. So during this time, I don't trade. I don't trade at all. I never trade this time. I have done it, 5 times or something. But like as soon as I see 12 or 12:10 hit, I'm pretty much off the market for until 1:30 hits again, if I haven't taken a trade during AM. But from 12 to 1:30, the market accumulates again. I mean, I wouldn't call this accumulation. I mean, you could call this accumulation. Maybe this range right here, accumulation. But then manipulation to the downside, and then distribution to the upside, and then continuation. Right? Accumulation, manipulation, distribution, continuation. Actually, this is reversal. What am I talking about? This is reversal. So this is continuation. This is reversal. It goes back into its range. Like you could consider this entire range accumulation, but it's because this thing distributed to the upside and this thing reversed to the downside. But this is after market hours. Nobody trades this. But this is how the 90-minute cycles work. Let's do one more day example. So let's do Thursday. So 5-minute chart, actually a 30-minute chart. 30-minute chart. So this is Friday. This is Thursday. So 4:30, which is over here. Excuse me. To 6, which is over here. Then we go back to the 5-minute chart. 4:30. All right, accumulation, 6 a.m. Accumulation, manipulation. This is fucking bullshit. I wouldn't trust this. And then distribution. So manipulation was to the downside. I mean, sure. Or maybe it was to the upside. It delivered to a buy side. The Judas swing delivered, meaning the price, the time is gonna be like. So, all right, how am I explain this easy? The time, it isn't perfect. It isn't to the tick. So if time delivers before it's over, before the 130 or the 90-minute cycle is over, it's just gonna accumulate again, right? So it delivered to buy side and pretty much went back into the range, right? This day is just a bullshit day. I wouldn't actually trust this day. So it accumulated to the upside, it distributed to the upside, or it manipulated to the upside, it distributed to the upside, it continued, or it reversed to the downside. Alright, I wouldn't just trust AM at all. This does not look good. Even though this 5-minute long looked good. Alright, this is not a high probable day. I think even if we draw out the 5 AM, it's not a high probable day. But yeah, that's not the 90-minute cycle. It's not every day, I guess. You'll just do Wednesday, right? Let's just do Wednesday, bro. Fuck it. 5:30, 6. Let's see this. Is this bullshit too? Accumulation, manipulation, distribution. No, this all looks good. Manipulation to the downside, I see. Goes back to the upside. Distribution back into the upside, and continuation or reversal. It reverses. This actually, all right, I know this looks stupid, but this is accumulation. This somewhat is a manipulation, but this is a distribution, and this is a reversal. And then accumulates again, manipulation, distribution, reversal, or continuation. So even though this manipulation phase does not look good, the distribution phase does look good, at least to me. But yeah, Friday looked the best. I say we just get off the 90-minute cycles for now. That was good enough. All right, so new day opening gaps, new week opening gaps, and opening price range. All right, so for the new day opening gaps, I do have an indicator for that. It's called ICT NWOG and NDOG gaps. But to see your new week and new day opening gaps, you have to go to regular trading hours here to the bottom right here. You have to go into that, and you see these times right here, right? So from right here, from 4:10 to 9:30, we have this huge gap right here. So it goes from here to here. So this would be the opening range gap, right? So from close to open, that would be the opening range gap. Opening range gap. This is the gap that the market tries to fill out as best, or like as good as it can. The market will never fill it out straight away. It actually did over here. You see the market opens and immediately filled the range gap. But we try to use the opening range gap to see if it will fill it. So if the market, say, the market opens up here, right? Up here. It does this. We will think that the market is going to go back into the range gap before like continuing up. So you would actually try to short this maybe, right? That's what like the average ICT trader would do. But the market got filled in the first 15 minutes. So just off the bat, the opening range gap is out the books. But the new day opening gaps, they are from what? I forgot. That's like, what was it again? Here, let me go back to electronic trading hours. Opening range gap. Oh, I guess you can only see those on the the electronic trading hours. But yeah, this is what the opening range gap is. It's this gap right here between on the 1 minute it is actually between the so as soon as the clock hits 5, the market closes, and then as soon as the clock hits 6, the market opens. So between this range from market open or market close to market open, that would be the new day opening gap on all days. And the new week opening gaps, which is, whoa, it's huge today. Let's see. It's from this closing day, Friday, to Sunday, right? So it closed on Friday at 5 and opened on Sunday today at 6, 1 hour and 30 minutes ago. So this would be the new day opening gap, or new week opening gap, sorry. The new week opening gaps, we can use that to enter our trades, right? We try to enter off new week opening gaps, but the market tends to bounce off new day opening gaps. Like it tries to touch it a little bit before reversing, right? Like you see it does it here, it goes back up, touches a bit before continuing down. Right here, I gotta sneeze, bro. But yeah, the market just taps it, right? Or consolidates inside it. But I rarely use new day opening gaps on NQ, but ES fucking respects the fuck out of new day opening gaps. Right? Respects it here, respects it up here. Respects it on these levels. You could have entered long here, right? On this CE2 or the main threshold. Where does it tap it more? Consolidates in it here. Like see new week opening gap, fucking touches it and straight back out, straight out. Over here, 5 minute again, taps it, straight back up. Taps it again, straight back out. Like ES respects new days and new weeks to the tick, while NQ just, you know, they're there, you know, they do tap into it, but they're there. But I only use new week opening gaps for NQ. I don't use new day opening gaps. But that is the opening range or opening, what was it? Opening price range, new day opening gaps and new week opening gaps. So through this video, I've talked about bullish candles, bearish candles, wicks, bodies, swing highs, swing lows, liquidity, sell side, buy side liquidity, relative equal swings, stop rate, change of character, break of structure, market structure shifts, fair value gap, buy side imbalance, sell side inefficiency, sell side imbalance, buy side inefficiency, balanced price range, displacement, divergence. Oh no, I haven't talked about divergence. Have I? No, I haven't talked about divergence. We'll get to that in a bit. I'll talk to that in a bit. So I will teach divergence soon. I have taught order blocks, breaker blocks, mitigation blocks, propulsion blocks, premium and discounts arrays, optimal trade entries, TGIF, main threshold, volume imbalances, liquidity voids, Judas swings at 7:30 and 9:30 a.m., power of 3, which is accumulation, manipulates into the midnight opening price and distributes above midnight opening price if you're bullish, vice versa if you're bearish. I've taught times to mark out, which is midnight open, 5 a.m. open, 9:30 open, 1:30 p.m. open, and 8:30 open. I am going to say 8:30 is optional as I typed on the screen just before. And then short-term, intermediate-term, long-term swings, and 90-minute cycles. I just went over an NDOGs, new week opening gaps, and then opening price range. And yeah, let's quickly go over the divergences. I'm going to change my candles back to neutral because this is actually making my head hurt. Cool. Alright, so actually I can talk about macros too. Actually, no, I'm not going to talk about macros. So divergence. Divergence is when NQ or ES, let's say NQ takes a high but ES doesn't. That's what we call divergence or SMT, smart money tool. I'm going to try to find an example of that right now. No, they both take the high there. Both take the low there. We'll just go on the 1 hour chart. They're easy to find there. Jesus Christ. Is there no divergence? I see divergence like twice a day. Oh, here's divergence. I'm gonna zoom in on this and zoom in on this. All right, you see I've synced up my charts, so you can see if I look over here, you can see on ES that these are the same things. So SMT is when ES takes a high, ES takes a low, or ES takes a high, but NQ doesn't, or vice versa, when NQ takes a high, but ES doesn't. Right. So this is SMT, divergence. Right. ES took this low, but NQ didn't. However, NQ is in a BISI. Right? Right. NQ is in a BISI. That means I would enter long here. Bada bing, bada boom. I would enter long right here. Aim for this high up here. This is what I would call a bull, like this is a bullish divergence. But when I see divergence, I say, hey, it's divergence, you know, there's divergence right there. But a bullish divergence for me just means it's a long entry on NQ, right? You could have turtle souped maybe this. But for me, if I would see ES took lows, NQ is in a bullish fair value gap, in a bullish 1 hour fair value gap, bro, I'm in the market. As soon as I see that shit, bro, I'm in. But this is actually a beautiful fucking trade. This is what, 600 ticks? Jesus Christ, in 2 hours? God damn. But yeah, as soon as I would see this SMT, I would go long straight away. Go long. I need to find a bearish divergence. Is this? Both take the high there. Both take the high there. Both take the high. Is this SMT? This is SMT. All right, cool. So again, you see this is synced up. We have this high right here and this high right here. NQ takes the high right here. This is Buyside liquidity. You're correct. You're correct. And ES, it's this swing point right here. ES doesn't. Is it in? It's in an order block. What's the main threshold of this? Main threshold of this guy. All right. Yeah. I probably. I don't know if I would enter that. Would I? Actually, I might. I don't know though. It's on the 1 hour chart, so I don't know. No, I don't think so. It's also at market close. Yeah, I don't know. But yeah, this is bearish divergence, or for me, it's just divergence. But for all other ICT traders, this is divergence, or bearish divergence. My fault. But yeah, so that was bullish divergence with ES taking lows and Q not taking lows, and this is bearish divergence with NQ taking highs, ES not taking highs. All right, that's divergence. So from what I just taught you, I am gonna show to you the trade that I took this Friday. Let me see. So I was on the 5-minute chart the entire time last Friday. Guess what? I took this short, bitch. I did. I fucking did. What I did when I took this short, right? I saw what I had marked out was the times, of course. But I also had this buy-side liquidity marked out beforehand. So I was turning bearish on the day. However, I was not blinded by like if the market was gonna go bullish, I wasn't blinded by it. Let me pull up the trade itself. Let me see. have it somewhere here. Give me a minute, give me a minute, give me a minute. Fuck. Do I need to? Bro, be fuck you for real. Oh, I had streaming mode turned on. Let me see. Here it is. No, I took the long. Is it on the 1 minute chart? Yeah, right here. This long. So I kept my eye on this BISI right here. I kept my eye on this one. However, I was more sure of this, right? I think we had SMT with ES on this. Right here. No, we didn't. Actually, we did. No, we didn't. I'm lying. I am lying. Yeah, all right. So both took Sellside liquidity, which is fine. But what I was looking at is this 1 minute fair value gap. I don't trade on the 1 minute. However, this is non-farm payroll, and I am a menace. I had my stop over here. I looked at the main threshold of this fair value gap, and I entered right there. I had my stop at this low, and I was aiming for 200 ticks, exactly 200 ticks. I wasn't really aiming for any fair value gap or something like that, but I had this one marked out up here. Yeah, stop below that low. I entered 2 minis, which netted me 1K flat, I think. Yeah, 1K flat. It is also, I'm looking at, like, I had this all journaled out. I had this propulsion block marked out. So plus PB. I had this propulsion block marked out. We did respect it, not by bodies, but we did respect it, however. And yeah, I netted myself 1K off that trade. I took another trade in this displacement leg. Why? Because this is a macro from 1050 to 1110. This macro touched this fair value gap to the tick. Institutional order flow journal entry is what that is called. Basically, the fair value gap barely gets tapped into. That's what's called institutional order flow drill entry. Like, it barely fucking taps the fair value gap. I get filled. I aim for 100 ticks flat. Like, I was just gonna take this low right here, and because this is a macro trade, but I aim for 100 ticks flat. My stop is just above the fair value gap, 25 ticks, 4 RR. So this was one micro trade, so that was plus 500. But yeah, that's what I do. I also, I wanna mention I had a fib marked out on this, like so. So this is what my chart looked like, right, when I was taking the long. I had this proposal block marked out. I had this fib marked out. I had this fair value gap and with main threshold marked out. And I had the win rate marked out. And for this is all I had marked out for this trade right here. I think, yeah, that looks pretty much exact. Yeah, so I did enter in a discount, right? Entered long in a discount. Stop loss below. And I had this SIBI marked out. I think that's all I wanted to cover in this video. This 1 hour and 30-minute video. I guess so. Thank you guys for watching this insane video. I hope you guys had everything journaled down. I want you to go to your charts, find examples, figure out what I just told you, journal it down. I want to see you guys take notes of this. Even though I talked fast, I hope you guys just paused, journaled it down, played back, went back. But I hope I gave enough examples. I hope you guys understood it enough. If you didn't understand it enough, just comment down below. I will recover it, go over it again. But yeah, my name is AC. Take care.